Today, is housing toast? Hello again, it's Martin North from Digital Finance Analytics. Well, latest post covering finance and property news. Friday evening, Tarric's back. Hi, Tarric. Lovely to see you once again.
The same here, mate. It's great to be back, and there's certainly plenty to talk about, as usual these days, I must say.
Well, it's never boring. Never boring. Always plenty to discuss. And of course, you've got the oil situation and the refineries blowing up all over the place. People complain, suggesting conspiracy theories. You know, were there drones over over the refinery beforehand? I don't know, but it is an interesting situation where there are so many variables, uncertainties, and I'm minded to just remind everybody that the government is here and they're here to help you, right?
Well, what do they say? It's one of the most dangerous sentences in the English language.
Exactly right. And it's interesting that they sort of go after the obvious, right? So suddenly, because there's an oil issue, now Albo's rushing around the region saying, help, help, help. You know, yeah, we'll get on giving you gas. Commercial contracts already agreed. And we'll hopefully get some petrol. Commercial contracts already agreed. So, yeah, it's very much form versus substance, in my view.
That's one of the interesting things I think that about all of this at the moment. Just the fact that you've got these two parallel things. You've got the narrative, and then you've got the reality. And I feel like we've got quite a bit of distance between the narrative and the reality, in the sense that, you know, Albo's flying around the regions trying to get all these commitments. And don't get me wrong, he's doing exactly the right thing in that regard. But the question is how rock solid are those commitments actually going to be when push comes to shove? Because the problem is that some of these countries that Albo's gone and reached out to, some of them derive over 75% of their oil imports through the Strait of Hormuz. And the question then becomes, how can they give us something that they physically do not have? And also a bigger question perhaps for the region is, who misses out if we get what we need? Especially in the light of the refinery fire, because that's more supply that we now need to import from overseas.
Yes, and as I said, you know, there are commercial contracts in place, but of course, commercial contracts are between, you know, commercial companies. They have a thing called force majeure in those contracts, which basically says, oh, we can't deliver because something beyond our control happened, like closing the Straits of Hormuz. And of course, we have seen a number of Middle Eastern countries already from their gas producers saying, oh, we can't produce force majeure. So there is this sort of get out clause. And I suppose it goes back to my point about, you know, you need to be seen to be doing things, whether in fact they help or not. A bit of a parallel would be Jim Chalmers over in Washington at the moment with all of the other, you know, hangers-on from the various conversations that are going on there at the moment with various economists around the world, and you know, everybody's saying, oh, it could be quite bad. You know, the latest suggestion is that well, we could see a recession if things go on a bit longer. And then, of course, you've got the other sort of form of a substance. Trump keeps coming out with lots of different things, latest saying, oh, we're going to get the radioactive dust, and et cetera, and everything's fine, and we're going to have an agreement very soon. Of course, talking the markets up. But, you know, again, you've got to say, well, it's hard to read what's real versus what people are just saying at the moment, because actually there's a gap, a really big gap.
I think that the gap is absolutely massive, and that's something that we'll get into a little bit later in terms of the gap between the physical world in terms of oil prices and oil supply and the paper markets that you see traded on, you know, on exchanges. But I think it's also just we've experienced something of a narrative shift, I feel, in the last few days, with Albo coming out and saying, well, we've secured 100 million litres of fuel, and that's only a little over a day's worth of fuel. And I think it's just interesting that that is now considered noteworthy. Are things out there so bad that now securing a day's worth of fuel is a big victory? And if so, what does that realistically mean for what the future actually looks like?
Yeah, it does beg the question, doesn't it, how this is all going to play out? And again, a lot of people seem to be saying quite a lot of things about what might be whilst what is, what they would wish to be, compared with what is. And sometimes I have to say that I find it a little frustrating that we end up with a set of conversations that seem to me to be, well, not really helpful when it comes to ordinary people trying to work out what to do and how to do it. When things are so difficult, sometimes it doesn't really help. And I think actually a lot of the stuff on social media doesn't really help either. There's a lot of there's a lot of stuff. You got to separate wheat from chaff in many different contexts.
You do, and I think that's part of the problem though, because the government has really left a vacuum with which people are trying to fill with information. Now, don't get me wrong, there are a lot of people who are trying to fill that gap with information earnestly. People who've built these websites to say track the number and amount of tankers coming to bring fuel into Australia. Now, but then there's obviously other people who are trying to take advantage of that. But at the end of the day, that is on the government for creating the situation in the first place. Now, this is something that the Queensland Premier has noted that in his view, that there needs to be a national dashboard, a website that people can go to see the tankers coming, the fuel situation, the broader assessment, all these things, so that the Australian people can be reassured that, that events are going relatively okay, or perhaps even favourably. But that is something that the government has so far resisted bringing to the party. And this crisis now has been going on for over 6 weeks. And it's a very disappointing situation, because you do see misinformation filling this disinformation vacuum. But then you also see the government, coming out, well, we've got 50, what it was, I think the last Bowen was saying 57 tankers coming to Australia, and that this is all fantastic. But by the same token, last month he was saying that it was fantastic that there was 81. Now, there is a huge issue there, isn't there? Because, people are going to look at that and go, well, 57 is a lot less than 81. But then by the same token, you could have a situation where you've only got 30, but they're all mega tankers and they're carrying more fuel than either of those combined. So they've created a situation where there is this vacuum of information, and then they switch back and forth between these different metrics, and people are just left really none the wiser. And you could make the argument that that is intentional, because realistically, in a crisis, the people should be informed.
Well, I think that's exactly right. And unfortunately, there's a lot of filtering going on. Of course, the advice is drive a bit slower and take your roof rack off, right? And that's going to solve the problem, isn't it?
Save the world, mate.
But of course, the other point is that people should understand that the financial markets, which are speculating on the future price of oil, are actually stuck between oil at sort of 50, 60, 70 and oil at 150, right? So they're sort of somewhere in the middle. But if you look at spot oil, so in other words, if you want to get a barrel today, in some places around the world, it's now 260, $270 a barrel. And that gives you a bit of a quantum of the gap between effectively what the financial system is saying about oil and what the real price of oil actually is if you wanted a barrel today.
No, absolutely. And I think that just serves to illustrate what lengths and what prices governments and companies are willing to pay when push comes to shove. Because removing, I mean, by some metrics, once you factor out all the various temporary mitigation measures, say like reserve releases, if you look purely just at the amount of production that will end up shut in if the blockade continues in the Persian Gulf, you're talking about over 13 million barrels a day. Now, to put that into perspective, when the world went into lockdown in the very early part of 2020, at the absolute height of the panic, the total reduction was 15 million barrels a day. So, trying to be able to create a situation where you've reduced demand by 13 million barrels a day is going to be hugely, hugely damaging, and everyone is going to try and avoid that. They're going to pay whatever price they have to. They will do the very human thing, and I'm not specifying anyone here. I'm just talking about humans and humanity in general here. Will beg, borrow, and steal whatever they have to fund the purchases of energy to keep their economies going, because this is existential. This is the difference between your economy contracting or and potentially collapsing, or business as usual, or business as usual with a heap of inflation is probably more likely the other scenario, and that is the stakes here. And I just think it's interesting that recently the HSBC CEO was interviewed by the UK Financial Times, and he was asked about the differences between the physical oil market, what people are actually paying for a barrel of oil, and what people are paying on the futures market. And he noted that there was an instance in Sri Lanka where an importer paid $286 a barrel for oil, which is, at the last time I checked it earlier this afternoon, more than three times the price on the futures market for the next deliverable contract. So it is just an absolute gulf between reality and perceptions. And I think that that's going to continue right up until the market gets slapped in the face by reality if this crisis continues.
Yes, that's the other Gulf War, isn't it? Not the one in the Middle East, but it's the big gulf between what the financial markets are thinking. I mean, look at the stock markets. Stock markets are almost touching all-time highs, right? Again, because they're actually speculating on the idea that, according to Trump, it's all going to get solved very quickly, and then we're going to go snap back into where we were. But I just want to remind everybody that after COVID, there was a snapback because basically we turned the economy off and turned it back on again. Now, here, we're in the situation that even if everything suddenly calmed down and the war stopped, you've got months and months and months of work to be done to begin to put things back together again, not least because, of course, a lot of infrastructure was damaged and needs to be repaired. But you've also got ships in the wrong place, and it takes a long time, as we know now, for the ships to go, get filled up, and then sort of appear where they need to be. So even if everything magically was reset and everything was solved from the war perspective, the gulf between that and when you actually start to see the normal flows of oil and other commodities landing in ports around the world is significant. It's months and months. And I just want to highlight again, it isn't just oil, it isn't just LNG, it's all of the other things. It's the helium, carbon dioxide, which is now another one which people are talking about, and a bunch of other things, all the polymers for plastic. So supply chains have been completely broken through this too. So it's going to take a long time for this all to get sorted out post the conflicts in the Middle East actually finally ending. And I will make another point. It is fascinating to me that, of course, for a long, long time, we've been talking about we need to get off the dependence of oil because oil, of course, is, part of the issue to do with climate change. And suddenly no one's talking about climate change anymore. Everyone's talking about, I need oil, must have oil. So it's almost like, well, that's an interesting observation. And then the other side of the equation is, and this is where we go back to some of the conspiracy theories that are out there, maybe it's actually a plan. Maybe it's a plan to remind everybody that actually you've got to get off oil because oil is actually unreliable and these long distance supply chains really don't work very well. Maybe there are other alternatives. And finally, I just want to make the point, of course, that we are in the situation where, particularly in Australia, because of neoliberalism, which says let the markets rip, we'll go and get the cheapest source of wherever we can from around the world, and we'll just bring it to Australia. And neoliberalism here has shown its flaws once again because markets actually are only interested in price. They're not interested in reliability and some of those other things. And actually, if you were thinking of leading a government, you'd probably want to ask yourself about, how reliable is this stuff? What happens if it goes wrong? And you and I think, have both spoken previously of the risks from these supply chains, particularly with oil. I know I said several years ago, we've got 30 days. That's not long. And look where we are now.
Indeed, I mean, this is something that you and I have been talking about ages ago, for a long, long time now. I mean, I remember, I think it might have been Senator Jim Molan from the Liberal Party, the former Australian Army general, who was a big advocate for energy resilience, for having onshore fuel reserves and all that sort of thing, talking about that a long time ago. But I think the thing is that not only that, but if you just look at this in the broader context of supply chains and resilience, this is something that you and I have talked about. This is something I remember you and Edwin talking about during the pandemic, that we are not a country that is capable of looking after itself. We're not a country that's capable of even supplying something as the entirety of the supply of something as basic as, say, saline for drips for people in, undergoing medical procedures, for any number of other basic things that should be producible in Australia. Instead, we have just pursued this situation of just higher and higher wages, higher and higher costs, and absolutely bugger all care for how we will endure should the transport and the sea lanes be interrupted. And I think the thing, just to put this into some, broader historical context, that this is by, the standards of history, a relatively small interruption in terms of overall trade flows. Now, don't get me wrong. In terms of energy trade flows in the post-war era, it's absolutely massive. It's the biggest on record. But in terms of looking at it in the broader perspective of trade flows, say for example during the Second World War, this is nothing. We don't have Japanese submarines out there blowing up our ships, or we don't have the sea lanes being cut off by a Japanese cruiser squadron in Java. We don't have those issues here today. Instead, it's just something far away that's impacting our very, very fragile supply chains. But the question is, especially as the world becomes a more uncertain and volatile place, what happens if there is a war? What happens if the issues with Taiwan go hot? I mean, if you had have asked someone perhaps towards the end of last year, do you think that the Strait of Hormuz is going to be shut for more than 6 weeks next year? People would have said that you were mad. They would have said, no, of course not. But that's the thing, wars, generally speaking, unless they're relatively obvious and telegraphed, are not generally expected. Well, not usually, but they often come out of nowhere. For example, the First World War, Franz Ferdinand gets shot in Bosnia, and then all of a sudden, it's on for young and old. And, as things become more volatile, more disjointed, and there's a greater level of what I would consider to be probably the best word for it is ambiguity in the realm of geopolitics, particularly with someone like Trump, who can weather vane, shall we say, on issues in terms of his public persona, at least. You know, that is an issue when you're talking about, well, what is going to happen with Taiwan? I mean, if you look at it from, say, a historical example, when Hitler invaded Poland, he thought that the British and the French would intervene. He thought that it would just be another one of Germany's many little conquests, like Austria or the Sudetenland or Czechoslovakia. He just thought that would be it. He was horrified when Britain and France declared war because he didn't see it. And that is one of the problems with international relations, because it's about expectations being wrong. Or, to quote Mark Twain, it's not what you know that gets you into trouble. It's what you think you know, but just ain't so, that gets you into trouble.
Such a good point. Such a good point. And I think it just shows you it shows you a few things. It shows you the fragility that we actually are living with at the moment. It shows you also that, some of the assumptions that people make about the way things work are actually quite disconnected from the way things really work. And actually, as I think about it, Tarric, as we move the conversation forward here, the fascinating thing here is housing and people actually getting confused about what's going on, an exemplar of what you've been talking about, right? And in fact, that leads quite nicely into your slides. So K-shaped economy here as the classic way into it. But we're going to touch on, first of all, some really interesting discussions about the housing market.
Indeed. As usual, the charts will be available on Twitter. On my Twitter, I will get Martin to put a link down in the description. And I just want to say thanks to everyone who has supported my work, both financially or just by following or subscribing to my YouTube. That is very, very much appreciated. So we shall get straight into it. One of the most frequent questions that I have got over the years is about housing. It's, why hasn't the housing market crashed? Why is it that all these other housing markets, the US, Ireland, Japan, all these other housing markets over the years have taken these big, big baths, taken big, huge hits in some cases, but Australia's hasn't? So what I thought we'd do today is go through a series of slides on that particular question. And we've got I think it's about 7 or 8 slides, basically charting why Australia's housing market has proven so resilient since about 2019. So what we're starting with here today is this is the change in borrowing power resulting from the cuts to interest rates. Now, what we've done here is this takes the rate, the average new variable rate mortgage rate in the third quarter of 2019, and then it charts it against what the average payable 3-year fixed rate mortgage looked like in 2021. Now, the reason why I've chosen fixed rate mortgages here is because that is what was very popular at the time. Because you could get a 3-year fixed rate mortgage for potentially, well, for at some points, the average payable mortgage rate on that particular product was under 2%. Mortgage rate's now 3 times that. But as you can see, it boosted borrowing power dramatically by over 20%. But if you were a property investor and you were someone who was looking to go interest only, it boosted your borrowing power by almost 2/3 to have the same level of repayments as prior to the pandemic. So it is a significant, significant increase to the ability to pay for housing, which naturally played a significant role in increasing demand, but also increasing prices during the pandemic years.
Remarkable, isn't it? And I think it's worth just highlighting, Tarek, that these are averages, right? So different households will be in different situations. But I see this in my analysis when I talk with people about the mortgages that they got and the sustainability of those mortgages. And of course, today, if you knock on the door of the bank, now the banks are on one hand saying, yeah, sure, yeah, now we'll lend. But when you actually look at what they can get, it's a little bit different from where it was. And I would remind you also that the 5% deposit scheme was, meant to be, well, help with the deposit, but that means that your mortgage is bigger. And that means, of course, what happens then, is you have to actually pay back more, which then the other criteria banks use, which is effectively, the cash flow and everything else, is actually extended. So it doesn't necessarily solve the affordability issue. And I've had quite a few conversations with people recently with regards to trying to figure out what to do because they've been shocked by how much some of these things have changed. And yeah, interest only and investors, they seem to be doing a little bit better than owner occupiers, which is, well, an interesting observation too.
Indeed. Now, this is an interesting one. Now, this charts the path of the proportion of new mortgages held by property investors over time. Now, this is based on the current ABS dataset, which stretches back towards the end towards the end of 2019. But as you can see, the share of mortgages held by property investors has undergone an absolutely meteoric rise since bottoming out in 2020. And property investors are again playing an absolutely huge role in driving this market. Now, I think it's just worth noting that if you look at the data relating to what proportion of housing stock is owned, of occupied housing stock is owned by property investors, it's about 27%. So at 40% of new mortgages, that does suggest that they are growing their share of the pie yet again.
So just to explain to the viewers here, I had to just change my audio system. We had a slight error on the way through, but we're back now. Tarek, sorry, I missed the very end of what you said on that last slide when you were talking about the property investor share of new mortgages. But it is pretty shameful how high it is. And of course, the implications here for people trying to get into the market are very significant.
Well, they are indeed. You're basically seeing a situation where you are competing a lot more with investors than you would have been previously. But I think it's just worth noting that historically, investors, and then we're talking quite a long time ago now. You're talking about 40 years ago in terms of the peak. 40 years ago, at the peak, over 60% of new mortgages to property investors were going for new homes. They were a major driving force behind the building of new homes, which is a great thing, which is a great role for property investors to play in the economy, to play in the market, and to play in society more broadly, because they were bringing properties to market. New properties, not just buying existing homes, which is overwhelmingly what property investors do now. And I think that part of the problem with Australian housing is that the price signals are broken in terms of rents versus the cost to buy. Now, if you look at, say, like for one of the property supply darlings examples from the US, say, for example, Austin, right? If you look at the price to build a home relative to the cost of, and when I say build a home, I mean including the land, including the infrastructure, including everything, the cost to build is cheaper than the cost to rent, and rent is still relatively affordable relative to incomes. So you've got a situation where a property investor can look at that and go, well, if I build houses here, I can make a real nice tidy profit just building them and renting them out. And then if I've got some capital growth left over at the end of the day, 5, 10 years from now, then great, fantastic. But here in Australia, generally speaking, unless you are a very skilled developer, or you're someone who's got a very keen eye for this thing, or you've got some very good mates who happen to be able to, go and do some work on your properties for you, generally speaking, it's very difficult to get a property that is positively geared from the get-go with a low deposit. So that price signal is broken. And in my view, until you get back to a situation where the price signal is functioning properly and functioning the way it did historically, investors are not going to be that driver of positive growth of building new homes that they were historically.
Absolutely. And I think that people don't necessarily get to see some of these sort of broader trends, because if you're an individual property purchaser and you want to try and get a property, whether it's an investment property or whether it's for own occupation, you won't necessarily go into the sort of the, well, how's the bigger picture faring? But when you see it rolling up, you start to see just how distorted the property market is. And in one of my one-on-one conversations over the last few weeks, people have been more and more twitchy because they're now thinking, well, interest rates are likely to go up. How much, of course, is the question. The banks are being quite picky as to where they lend and how they lend. But this is a market that is not a free market. This is a market that is effectively significantly distorted, partly because of the huge amounts of government intervention left, right, and centre, and also because of the way that the banks choose to lend for particular purposes rather than other purposes. And go right back to what I said earlier about neoliberalism. Neoliberalism in the housing market has actually led us to a very bad place. Many people can't afford to get in and probably never will. And that's before we start talking about the fact that now the listings are going down potentially too.
Indeed. Now, this is a really, really interesting one. This goes back to, I have the listing data here from Cotality going back to 2012. Now, the thing that makes this interesting is just how underappreciated it is. Because the reality is that there's so much focus on, oh, there's this, property prices have gone up this much, oh, there's this much demand, blah, 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 blah. But the unsung element of the property market is that the plummeting number of listings on the market. So as more people come in to an attempt to purchase a property, there's less and less properties on the market to choose from. So there's the same amount of coin chasing property, but there's fewer of them on the market. Now, if you look here, going back to the peak of this particular chart in 2012, and you compare it to where listings per capita are today, total property listings have fallen by almost 2/3. Even if you go back just prior to the pandemic, they're very nearly halved compared with where they are today. So this is a really underappreciated element, because the thing is, eventually, when you don't have when you don't have the impact of record high migration still feeding through the system, when you don't have a rental crisis, when you don't have all these different factors, even the government's new 5% deposit scheme, the expanded availability of that, all these different things pulling forward demand, increasing demand. eventually, when those things are no longer acting on the market to increase demand, you're going to see listing numbers begin to eventually normalize. And when that happens, that is going to be a headwind for the market instead of the tailwind that it's been. People say, "Oh, well, why hasn't property crashed?" This is part of why. There's just hasn't been enough listings on the market for people to really be forced to take lower prices for their homes because there's so much demand in the market and there's just not enough on market supply.
Yes, and it's worth just underscoring again that is per 100,000, right? And of course, we know that the 100,000s are actually rising quite fast because of the high migration. So, despite the fact that we're still building some properties and supply is, quote, increasing, according to the government, it's not necessarily in balance. And that, as you say, is one of the reasons why property prices are still stickily high at the moment. Although I do feel, looking at my data and talking to people, that they're actually getting to the point where they just can't reach any faster and higher, going back to your earlier points as well. And that means that potentially we could be in a rather different situation, especially if interest rates go higher and we also get an economic slowdown. But the critical determinant for me will be unemployment. If the unemployment rate, which came in at 4.3% over the last little while, doesn't go up much higher, then maybe that's not an issue. But if unemployment continues to rise, the RBA was suggesting up to 4.6% was likely before the Middle Eastern situation blew up. And some people are suggesting it could be a 5 or above 5. And if, in fact, unemployment continues to go up, that's going to then change the equilibrium in terms of people's affordability and ability to be able to service mortgages, which might in turn change the supply dynamic as well.
Well, indeed, there is definitely that factor. And although I think one of the things that's going to be really interesting going forward is extend and pretend. Now, we saw a recent announcement from Jim Chalmers relating to, I believe it was the recent cyclone and people impacted by that, and basically how the bank should effectively go back to extend and pretend. Just, well, you got to cut these people a break. It's been a rough, blah blah blah, etc. And well, it's not that hard to imagine that if the country gets whacked by a recession that results from external factors, that once again we're going to see the government push the banks towards back towards extend and pretend again. And we've even seen recently as well the government pushing for those loans to businesses on favorable terms for them to endure. And and if we go back, that's originally what the TFF was for. If we remember, that was originally intended to help the banks provide liquidity to be able to then lend to businesses to help them to get through the pandemic. But I spoke to some of the media reps from the big banks, and they tell me that it didn't have that effect at all. It didn't. It just the people who were getting credit before the pandemic were getting credit during the pandemic, which is no surprise at all, really. And so basically, but what it did facilitate is the creation of 3-year fixed rate mortgages, which ended up at a rate of under 2%, which, as we previously mentioned, helped send housing prices to the moon. So I just think that is something that is rather interesting. That it's not really about businesses; it's about housing, because this is Australia.
Well, everything is about housing. It's by far the biggest and the prime sport at barbecues and everything, isn't it? But I will make this point that the extend and pretend, which included, if you think, ultra low interest rates, raiding superannuation, as you say, lending money to the banks to be able to get them to lend on, mostly to housing, at very low rates. That pushed house prices up dramatically, in many areas up more than 40% in 12 months now, if you look at it historically. But post that, as things sort of settled down, the banks extend and pretend really didn't. So they continued to offer interest only. They continued to offer extending loans because, of course, if you extend the life of the loan, you actually reduce the monthly repayment a little, although you pay more interest over the life of the loan. And so we're actually already on a high plateau of extended and pretend. And the likelihood is, if we get this impact from the Gulf War coming through as we expect, and we see effectively the government having to throw a lot of money at it again, I would expect to see us play that again. But we're building from an already high level to extend and pretend. So it's going to be what? Extend and pretend squared.
Pretty much. And I think that's the thing in all of this is that we are already on a crisis footing. If you look at the expansion in the size of government from the time the Albanese government came to power till now, so we're talking about day-to-day government across all three levels of government, local, state, and federal. So this is just daily consumption. This isn't, this isn't infrastructure and, new roads or whatever. This is just day-to-day expenditure. The expansion of government over the last, what is it, 3.5 years of data is on par, is only just a few tiny measures of a percentage point below what you saw following the 1990 recession. It's larger than what the Fraser government did following the 1983 recession. So you've already got a situation where the government has already turned up support for the economy to 11, just not in the more traditional ways. It's just gone, well, NDIS up to 11. More fund, funding for, say, for example, for childcare subsidies up to 11. And it's not because more kids are in care. It's just with the fact that the government expenditure on it has gone to the moon. So there's all these different things that keeps injecting more and more and more cash into the economy. But we're acting like it's a crisis even before the actual crisis came to being, because the data I'm talking about predates the war.
Absolutely. And that's the point. We're already at a situation where we've got high level of government spending, high level of government debt. The budget, of course, coming up in May. Chalmers is making all sorts of commentary about, well, we're going to try and be responsible, but we're going to probably need to provide some more support. You can see where it's all going to drift to. I would expect to see, Home Builder 202 and radio superannuation 305. I mean, I can just see all of these initiatives coming through again, and it doesn't help to solve the housing situation. It just blows housing prices even higher and makes it less affordable for people. But I suppose the government is always saying, well, we have to look after Australians, and that means looking after the housing market, doesn't it? Can't allow housing property prices to fall, can we?
Well, I mean, I think that's the thing, isn't it? The government has made it very clear that they do not want a free housing market. I mean, I'd say, the commentary from Claire O'Neill on this is very, very clear.
Yes.
We want higher housing prices. We are not interested in lower housing prices. That is not the policy of this government, which is, I quote directly from the housing minister's commentary. And
Yep.
I think that's the thing. There's a term in software development and particularly gaming development, working as intended. The mechanic is working as intended, and their policy is working as intended. Perth property prices have gone to the moon, working as intended.
And that's really the point, isn't it? And I always think of Saul Estlake at this point, because he always says, just remember that there are more people who hold property than are trying to get into property. So, of course, from a sort of just a pure numbers perspective, the government is going to be focusing on those who already hold property because they outweigh the others.
Yeah. Well, I think that this is an interesting one though, because I mean, I'd be really curious to see some in-depth polling into this particular issue. I mean, I realize that Australians really love their high property prices, but do they love them to the point that they don't want their kids to be able to afford homes, or to be able to afford, what people would consider to be a home that is, shall we say, representative of their relative earning power, you know, based on, their earnings percentile? Because I think one of the interesting things for me is, like, I talk to people, say from Sydney, for example, people who had parents who were tradies, mechanics, nurses, yeah, etc. Just, sort of regular everyday professions whose parents, so in some cases on one income or one and a quarter or one and a half incomes, bought these houses that are now worth two. 2.5, $3 million, and now there's their children who are earning much, much higher than median, double median, triple median even, who can't afford that house that was once affordable on a single income or an income or a sing, maybe like one and a quarter incomes. It's just that situation now where it just doesn't work. And I do wonder to what degree there are people out there who've sat back, done the math, and gone, "Wow, you guys really are getting a raw deal."
Yeah, it is interesting. And I would make two other quick points on this. Of course, you've still got the banker mum and dad going gangbusters. So the generation that's sitting on the property equity is raiding that equity and handing it down the generation, which means that if you actually are in the fortunate position of having families who actually have property, you can still probably buy property. Whereas, of course, if you don't have them, you can't. And the other is that if in fact stock markets begin to actually go down because of the fallout, the global recession, as the various projections in Washington this week suggested, that might mean that in fact some of those banker mum and dads get themselves in difficulty too. So this intergenerational wealth question and the complications of that need to be factored in as well if you're trying to sort of figure out this out. But you're right, a lot of people probably have never specifically been asked the question about, do you really want house prices to be so high that your sons and daughters will never buy?
Yeah, I think there's a lot of social questions around a lot of these things that need to be asked of people, and I think the thing is that I think there's a reason that question isn't asked more often, because I think it would raise some rather uncomfortable answers potentially for the government, because, well, not just for the government, for the political class more broadly,
Yeah,
really.
no, absolutely. And it is, it's a broader question for everybody. Now, the other interesting observation, if you think about what's happened, is what's happened with household size, right? Because that's an indication too of maybe things moving a little bit awry. Because obviously, if you can't actually afford to buy your own place, you're going to be living with your parents, or you're not going to actually form a household in your own right.
Indeed. Now, this one refers to a chart from an RBA paper from 2023. Now, what the conclusion was that the RBA came to was that basically through solely the change in household size, and which is basically an expression of household demographics, it increased demand for housing by 120,000 homes. Now, I think it's worth just exploring this particular issue because I think it's really an underappreciated one. If you look back through the ABS data on household composition going back to, say, I think it goes back to about 2005. Back then, household size and household demographics was basically a near neutral contributor to housing demand. So things were basically just, going along at roughly the same kilter as they were previously. So this wasn't adding to additional demand for homes. But if you look at the more recent data, which has particularly been driven by the rise of the single person household, as evidenced by the chart here, which has risen significantly, and this is obviously just one part of it, but it is driving demand for housing without adding a single additional person. Now, if you just look at the ABS data and extrapolate that out across the broader population, it is increasing the demand for homes by somewhere around about 50 to 60,000 homes per year. So you're talking about a situation where, on average, about a third of the new dwelling completions that occur each year are being consumed purely just through these household demographic changes. Now, there are other factors in this which are quite interesting. There's some research from the US that shows that one of the reasons why this is happening is because younger people, Gen Z, Gen Y, are less likely to couple, more likely to be single than in previous generations. But on the other side of the coin, my own research shows that one of the mitigating factors against the increase to housing demand is also just the fact that people simply can't afford it. So you're seeing stunted household formation and household formation rates at about, I think, from memory, it's about 16% lower than the peak rate just prior to the big Australian migration intake beginning. So there are a lot of different factors there, but basically the long and short of it is that demographics, purely by themselves, are this huge driver of housing demand. So you've got all these people who are wanting to buy additional homes without actually adding and considering all the additional people, which we'll get to in a bit.
Absolutely. And I'd also make the point that if you are a sole household formation person, so rather than having two incomes, it's almost impossible to get a mortgage that actually you can afford to service. The banks won't give it to you. And, I've highlighted before CBA now, when they talk about housing affordability, they use a baseline of two full incomes relative to the housing price. Now, if you go back a couple of generations, it was one income plus a bit, but now it's two full incomes. So the assumption is amongst the banks that you're going to have two full incomes to get a house.
Well, I think there's a lot of different elements from the past that no longer apply. That's obviously just one of them. But I think there's also the fact that if you look back to say, for example, the 1980s, or even better, the 1970s, people say, well, interest rates went up, and look at how much they've gone up, blah blah blah. This was this huge blow, etc. But what I did is I went back through the RBA's data on mortgage rates going back to 1959. And what it actually shows is due to the impact of rising wages, you actually end up with a situation where households are very, very rarely worse off after accounting for income growth than they were previously. Even, the famed 17% days of 17% interest rates, when they went from about 13 to 17.5%, the actual increase relative to people's wages was actually relatively minimal. Now, admittedly, this is entirely based on averages, which, as we know, is problematic. But unfortunately, when you're talking about data that's almost 40, that's almost 40 years old, you got this situation where, yes, obviously, it's not going to be perfect. But on an average basis, I think that just proves illustrative. But if you fast forward to the present, oh boy, you can't keep up. It's with a mortgage that's gone from 1.9% to 6.5%, like, over a relatively short number of years. And when you're talking about wages growth, that's not like the days of, the 1970s when it's like, well, how much did your pay increase? Oh, 15%. I mean, like, I sometimes, talk to friends about this. Like, there is an instance back in the 70s where some of my friends from who were in that particular era, they got more wages growth, more real wages growth in a quarter than the people of my generation have in my entire adult life. it's it's really something.
Yeah. Well, I can remember I was working in 1973. And of course, 73 onwards was when the inflationary pulses were extremely strong. And so, yeah, I got used to very significant quarterly improvements in my income to keep me ahead of the pack, as it were, in terms of the inflationary pulse. And the quantum of increases would, yeah, as you say, would be significantly higher relative to a lot of people's working life in recent years. My data shows this really clearly. So, half of mortgaged households have a cash flow pressure. It's getting worse. Three-quarters of people in the rental sector have a cash flow pressure. It's getting worse. And real incomes, despite what Jim Chalmers is talking about and saying, well, yes, we need to try and maintain lower paid workers' income growth. In real terms, people are still going backwards. And so it's impossible for them to be able to actually even contemplate potentially making that next property move or getting that property for the first time. And this is a really big implication for society, for social norms. And, the demographic changes here we're talking about as well, overlay that, as well as the economic ones, indicate why we've got us up into this cul-de-sac.
Indeed, and I think one of the things that I find really interesting about the whole demographic question in the context of housing is part of the motivation of policymakers and all the the various public servants who are part of this apparatus is we need to have migration because of our aging population. But this completely ignores the fact that the aging population ends up changing the demographics, ends up requiring more housing. So you're creating a situation where you're bringing in more people who are going to require more housing. But then you're not accounting for the fact that the demographics are aging. The very thing that you're talking about is driving the fact that you then need more houses. So it's just a rather just impossible set of circumstances, but is almost completely ignored.
Well, and I'd say that the joined up thinking that we're trying to get to here, which is you link together all of these factors, is the problem, right? Now you've got the states and the feds effectively, owning bits of the problem. You've got the financial services regulators holding another bit of the problem. You've got the RBA holding another bit of the problem. But nobody joins all of this up to ask, what is the real consequences of all this and what does it mean for policy? Now, that is what we should have. We should have joined up thinking, but no, we don't. We have fragmented thinking, and we have short-term political thinking because, of course, we have these election cycles, which mean that, of course, politicians really, their main priority is to get re-elected.
Well, I think the thing is that you end up with fragmented thinking because if you don't have fragmented thinking, if you do have unified thinking, you do have an appreciation of a public appreciation of the problem. I mean, people understand this; they're not idiots, Like policymakers get it.
Yes.
Well, I mean, some of them are idiots, but you know what I'm saying.
Yeah.
But the thing is that once you identify a problem from a political perspective, you then need to address the problem. But if you just pass the buck and say, well, that's a state issue, that's an APRA issue, that's an RBA issue, it's a local government issue, then you can, foist the problem off onto someone else, who's then going to foist the problem off onto someone else, and it's just a giant perpetual motion machine of just blame shifting. And I think that people are just not really adequately engaged enough with this issue with, shall we say, passion for it to really be forced to change.
Yeah, and the other point is, of course, that it's hard for politicians to message on a multi-dimensional problem, right? It's much easier to say, we'll just build more houses, that'll solve the problem. Or we'll allow you to buy a property with 5% deposit, because those are simple things to communicate. They seem to be doing something, but they're not really doing anything that's going to solve the fundamental structural issue we've been talking about here. That's really the problem, because the truth is, this is a complex problem, but the point is that if you actually tackled it right, there are also solutions.
I'm honestly sometimes tempted to just create like a sort of caveman type political communications company with just the most simple, narratives that would make Fred Flintstone look like a rocket scientist.
One grunt for yes, one grunt for no, or two grunts
well,
for no.
Perhaps
right?
a little bit more sophisticated than that. I was thinking more along the lines of housing expensive, eventually this crash economy.
yeah.
Because the thing is, like, you look at the data. I mean, then you can go a little bit deeper, look at the data, and say, well, look, you've got a situation where real per capita spending for people under 45, so people aged 18 to 45, peaked almost 20 years ago. How can you run an economy when basically half of your population, and obviously this is at a per capita level, are seeing their real spending contracting compared with where it was 20 years ago? It's just a completely non-viable thing. And, also, just to clarify, that is spending X housing. This is so consumer spending, as it's otherwise called. How can you operate an economy like that? And a robust economy, shall we say? And the answer is, you can't.
Absolutely. Well, it's so fundamental to the structure of the economy, and unfortunately, we do seem to be muddling along, extending and pretending, and all sorts of levels. And now, of course, the the Gulf War is going to probably cast an even sharper spotlight on some of this stuff. Now, let's talk about some of those demographic. You've got an interesting chart here about the demand for housing due to demographic changes, which is also, I think, just worth understanding too.
Yeah, this is the chart that I was referring to earlier. Now, what this shows is just solely the change in housing demand driven by the change in the average household size. Now, as you can see, you ended up with a situation there in 2023 where it rose by over 60,000 homes. And as you can see, it's been trending up there for a good long while now. Now, obviously, there was the impact there of the pandemic and obviously the rental crisis there because people just couldn't get more homes. But yeah, I just think that just illustrates just the challenge that we have. And I think it's just worth noting as well that this is what it looks like with people actually able to form households. Yet, if you talk to someone like Shane Oliver and you look at his data, he estimates that the shortage of homes is somewhere between 200 and 300,000. So that is additional demand that's there that isn't being met. So I think that there's a very, very severe issue and a very serious problem that is just not being adequately covered or adequately addressed by the government because at a coalface level, you're talking about people being stuck in situations that they don't want to be in. They want to go off and form their own household. They want to leave a bad relationship or an abusive household, but they can't because it's expensive or because there simply isn't enough homes in their area or even the broader area for them to either be able to A, afford or B, have available to them at all in some cases. And it's frankly heartbreaking to see some of these stories on community social media groups which people send me sometimes or I get from friends and family from people who just want to get out of a bad situation but they can't. And that is honestly just it. And the fact that the government knows this, the fact that the National Housing Supply and Affordability Council says, yes, the problem's getting worse, and yes, the problem's going to get worse until at least the middle of 2029, when our forecasts end, is shameful.
Yeah, it is, because it shows that there's been a massive failure for a long, long period of time. And yet each generation sort of gets piled on the top of the previous generation. Average first time buyer's age, much higher than it used to be. Average household formation age, much later than it used to be. Birth rate continuing to fall. Uh, oh, we need to bring in more people then. Okay, but actually that puts extra demand on supply as well. So, yeah, the policy settings from government are actually driving the economy into the ground.
Yeah. Well, I mean, I think one of the things that I just find just ironic and just a bit wild, really, is the fact that if you look at the data on fertility rates, right, the average Australian woman is having about 1.65, sorry, Australian born woman is having about 1.65 babies per woman in terms of total fertility rate. The average migrant born woman is 1.25. Now, if you look if you then take a step back and you sort of try and remove the issue of housing a little bit, and you look at, say, for example, regional New South Wales, or in as it's expressed in the data, New South Wales excluding Sydney, that geographical area has a fertility rate that's roughly the same as India's. So it just goes to show that, there are issues there that can be addressed to improve things, but aren't. Although I will say, considering the deterioration in housing affordability and rental affordability in regional New South Wales in recent years, that's going to take a big hit. But obviously, it's about how would I describe this? It's about the lags. It's about, obviously you don't just go straight from I'm at home and now I've got a child. I've got a, generally speaking, it is a bit of a longer process of forming a household, perhaps even purchasing a home, etc., before you bring a child into the world.
Yeah, there's a bit of a process in there, as you say, and that can take quite some time. Interestingly, of course, if you also look at it from a working age population perspective, this is another very important chart that people need to look at because it shows you that, well, things have gone off the rails, really.
Now, I love this chart. This is one of my favorite, one of my most favorite ones I've ever put together. Each each one of those big spikes. So you've got the spike there in the mid to late 1980s. You've got the big spike there in the just around about the financial crisis, and then you've got the big spike more recently. Each one of those represents a rental crisis, which I think is rather funny. Each one of those represents a dramatic surge in rents. So what this basically shows is the number of working age people per dwelling completion on a rolling annual basis. So generally speaking, at around about 1.5, which is the average, over a long enough time you can get away with it. But once you start getting above that, which is what we saw with the beginning of the Big Australia era and post that particular time, is basically you continue to see downward pressure on household formation rates for young people. You see upward pressure on home prices, and it just ends up being a very, very challenging situation. And I think that this just proves illustrative of the fact that even though the Albanese government has cut migration relative to the number of new dwellings that we are bringing to the market, the migration cut is nowhere near enough. And I'm saying it's nowhere near enough to address the number of people who are currently coming in today. It's not, and that doesn't even begin to cover the shortfall that the likes of KPMG, Shane Oliver, the National Housing Supply Affordability Council, and a plethora of others see as a major long-term deficit for the housing market.
No, and I reckon if you actually was to take that chart and overlaid the rental growth and home price growth, guess what? There would be a massive correlation, right?
Generally speaking, yes, there is that correlation. I mean, the only one where you would see that major departure would be during the pandemic,
Yeah.
because obviously, but that again was, if we go back to the RBA data, driven by the surge in household formation. So I mean, if I had data on household formation, then it would probably be perhaps a little bit better. But then that obviously cancels out the impact of the fact that the housing household formation's been reduced. So it's just a mess, really. It's just a very, very challenging situation that is obvious when you look at a chart like this, but is then ignored by policymakers because realistically, like as I said previously, without migration, the economy for under 45s just isn't growing. So you need, well, you don't need it. Politicians need those people to power GDP growth.
Yeah. Jim, if you're watching, we've got to make some suggestions here for your upcoming budget, right? Look at it holistically, right? Understand how the housing element fits into the broader jigsaw puzzle. Don't just assume that you can actually bring more people in and that will solve everything, because it won't. It will actually just create another version of what we saw over the last few years. And no, don't extend and pretend again. Be serious this time, because if you don't, well, we're going to actually end up in an even worse position economically speaking. That's that simple, isn't it, really?
It is, and you know what I think the problem is? Jim knows.
Yeah, that's right.
Jim knows.
He probably does, yes, indeed. But will he do anything about it? No, because he's thinking, oh, I'll be leader one day and I don't want to rock the boat before I get to there.
Well, the question is will he?
Yeah.
Will he? I mean, I do wonder if he's going to be Frydenberg to Albanese's Morrison, that he will be so damaged by his ties to his leader as treasurer
Yeah.
that it will be political poison for him.
That's a really interesting question. Well, we'll come back and revisit that as time goes on. But just before we finish, you got a little bit of information specifically on the dynamics of the Hormuz situation, the Gulf War. And I think it is just worth cycling back because this is a very immediate issue at the moment.
Indeed, this is a really interesting one. Now, what this shows is we've got 20 million barrels of oil and condensates and fuels coming through the Strait of Hormuz on a normal pre-war day. Now, that's mitigated on a longer term basis by the Saudi East-West pipeline, the pipeline to Fujairah across the United Arab Emirates, and the potential restart of the capability of the Kirkuk pipeline from Iraq into Turkey. So those are our long-term mitigation elements. On a short-term basis, there is the release of strategic oil reserves. There is also then the waivers on Russian and Iranian sanctioned oil, which will also bring barrels back to the market. But if you note, just in the second column there, the fact that Iran was still exporting when this chart is produced. Now that was good for, depending on the estimate you go by, whether you go by ANZ, Macro Bond, Kepler, etc., somewhere between 2.1 and about 2.3 million barrels per day of various products. That's gone now because of the new American blockade. So you're potentially going by the numbers here from Commodity Context, which is quite a good source for information, I find. You're talking about a shortfall in oil of around about 15 million barrels a day. And that is roughly, as I mentioned previously, about how much oil consumption fell during the absolute height of lockdown at the peak of the pandemic. Now, we're not doing that again, obviously. So the question then becomes, who misses out and how bad does it get?
Yep. And that takes us nicely on to this point about what are people prepared to pay for that barrel of oil. And it's a pretty shocking number, isn't it?
It is. Now, this chart here is from the Wall Street Journal. Now, what this shows is the price of a barrel of oil, dated Brent, which is basically for delivery, but within the next 10 to 30 days. And then you've got front end month Brent futures, which is futures for the following month for oil. And as you can see, since about mid-March, the two have diverged dramatically. Now, Brent oil is oil that is generally in, well, it's oil for Europe, basically, in terms of the pricing point. So prices in Asia in some cases are even higher. So basically you've got this massive divergence. Now, we're going to keep out of the realm of conspiracy land and we'll keep with what we know. There has been some discussion that this is being driven by interventions in the oil futures market. The Japanese government did say that they were considering intervening in the oil futures market. We've also heard the consideration of there being intervention by the US in the oil futures market. Now, to what degree this is occurring, we don't know. We're probably not going to know for a long time if we ever do know. But there is a major disconnect between the price of oil on markets and the price of oil in terms of oil for physical delivery. So, you know what? We're just going to go to the next chart on this, the final one of the day. This shows the gap over time between dated Brent and the nearest deliverable futures contract. Now, as you can see over time, it's all over, it's a little bit all over the place within a relatively tight range. Excluding, you've got there on the chart there on the right, you've got the impact of the global financial crisis, where you saw the gap turn negative. You've then also got the gap turning negative during the onset of the pandemic, and also then the volatility driven by the war in Ukraine. But as you can see, what we are seeing now has not been seen either ever before or in a very, very long time. So there's this huge gap between the physical world and the digital world of paper oil futures. So the question then becomes, which one is right? And I have a feeling it's the one that lives in the physical world.
Well, ultimately, it's about grabbing oil at any price because oil is critical for society to continue. If you suddenly turned off the oil completely, you'd be back to what, horses and carts and not a lot else really. Grow your own veggies, I suppose. But the point there is that people will be prepared to pay a lot. And of course, it's interesting in Australian terms. I think the government is helping out by helping to buy or underwriting some of those higher prices to be able to make it work. I also believe that the financial markets and the financial speculation that we've seen is pretty dramatic. And I noticed that some of the big banks who were reported recently in the US reported a very strong quarter because of the volatility, because of all the trading. And that, of course, would include oil futures as well, other things too. So, yeah, there are winners and losers here. And like I said at the start of the show, spot at the moment, in some places, in some countries, people are prepared to pay more than $250, $260 a barrel just to get some oil. So, yeah, it suggests to me that the futures pricing is over optimistic in terms of where it's going to get back to for all the reasons that we discussed earlier on. And I guess we'll see, but it shows you again how much of the world's future is being determined by a set of dynamics that actually is more about making money than anything else.
I think that's definitely a major part of it, but I think it's also the fact that in terms of the futures market, you've got Trump to be concerned with. Like, if you're in the physical oil market, you know that you physically can't get a barrel of oil to export or Y-port in time for it to impact the price.
Yep.
So you can safely make bets on that market on with that knowledge. But if you're talking about playing the futures market, and you're, say, for example, you're there going long oil, a single Trump tweet that the war is over can just burn you out of your long position, you know, give you a nice hefty loss and a metaphorical black eye to go with it. And literally oil can be back where it was, 3, 4 hours later, but Trump's done it, has already done the damage to your trade. So I think that's part of the problem as well. People are just fearful of acting as if it was a normal market because you've got all these, all of a sudden you can have, oh, well, we're going to we're going to destroy their civilization. And all of a sudden the price of, the price of oil shoots up, or then you've got the war is over and the price falls, $5 or $10 a barrel. And like these moves on a normal day would be huge. So you're talking about taking like fairly sizable hits. So I mean, from what I've read from some oil traders and energy experts, they're just that they find that the best way to win this particular game is to simply not play.
Absolutely. And of course, there's also this cost of carry idea, which, if you can actually buy here and you can sell there, you can make some money, and that necessarily generates profit for somebody. But on the other side of the trade, there's always a loss, and that's the point. And of course, we shouldn't also mention insider trading, but we suspect there's been quite a lot of that with, funnily enough, oil's futures prices moving 15 minutes before Trump makes an announcement. Well, I wonder how that works.
No, I'm so surprised that I can't believe that anybody would do that.
No, quite remarkable, isn't it? Tarek, I think we've brought this conversation to a very interesting point. We'll watch and wait what happens with the Gulf War in the Middle East and oil prices. But meantime, Australia's situation is pretty dire with regards to oil supply, but also housing as well. And have we got the government that we need to be able to get us through this mess? Well, I guess we'll know in a few months' time.
Yeah, I mean, I doubt it, but I mean, look, I'll be honest. I think the thing is like, Albo is an unimpressive crisis leader. I think that's the nicest way of putting it. But I mean, maybe one at some point, Albo will ride off into the sunset to his nice cliffside home on the New South Wales coast, and we'll have someone else running the show, and maybe that'll be different.
Well, of course, if it's a caravan, then we're going to do it all in Australia, aren't we?
Well, I would be very surprised if the Liberals get anywhere near government in their own right anytime soon at this stage. I mean, although I will say one thing. If we do see a continued crisis, and if Australia is, continues to be over the barrel in terms of fuel and, those various issues, my feeling is that Albo's polling and Labor's polling is going to take a rather sizable hit, because I think that people are going to see that this was not preventable crisis, but it was one that we could have mitigated a
Hmm.
whole lot better. I mean, I think if we had, say, even if we just had the standard, IEA 90 days worth of reserves and we just did a little bit at a time, maybe a couple of 100,000 barrels, that's something that we could have kept up with for, potentially for a couple of years. Just slowly, little by little, maybe not years, but about a year or so.
Hmm.
It was a viable thing, but with some of these things only having, you know 29, 27 days, it's a whole lot harder. And the thing is that you also need to be prepared for the downside scenario as well. You need to be prepared for the scenario where, I mean, there was reports in the media that Australia obtained a cargo of fuel from the Netherlands, and then somebody obtained that cargo from us.
Yes, that's right.
So,
Yes. Well, it goes to who can pay the highest price. I'd also make one quick final point, and that is, as you think about all of this, and you think about, what politicians are thinking about, 8 refineries to 2 over a period of time should have been a warning signal. And the other point is that the costs of actually extending from 30 to 90 days, which would have been a significant price ticket, pales into insignificance if you think about the total amount of money that's being thrown at AUKUS at the moment. And I read now that the cost of AUKUS is going to go up even more. So, in terms of pure defense of the country and keeping the economy going, where do you place the dollar investment? I'm not sure it's in AUKUS.
I think one of the biggest problems with all of this is that it's about priorities. It's about understanding, and it's about priorities, and it's about costs. And I don't just mean costs in terms of like the sticker price. I mean it also just in terms of now what it's going to cost the country. If we do see any significant rationing of fuel, the economy is likely to contract. Tax revenue is likely to take a huge hit. And all of a sudden, spending let's call it $10 billion on those expanded oil reserves to get us up to meeting the international standards that we've agreed to meet, I might add.
Yes.
Getting us up to those particular standards, we could pay for that in a couple of weeks in terms of the costs that it's going to impose on on even just purely on the government's coffers. And also just the fact that, from a social perspective, running low on fuel and experiencing rationing and all these other different issues that are going to come up in that scenario, they're profoundly unfun.
Sounds like a really good insurance investment. Insurance is sometimes about protecting against things that hopefully may not, but may happen. And government, I think you let us down here quite badly. Tarric, thank you so much for all the work on the slides. As always, great to catch up with you on a Friday. I'll look forward to next time. By then, of course, there will be another load of things to go into. So I'll look forward to that.
No worries, mate. Thanks for having me. And, as always, I look forward to our next chat.
See you soon. Take care. Thanks,
You too,
viewers.
mate.
Bye.